Hi, welcome back to Super Macro Podcast 3. My name is Elvis. Opposite me is Jonny Matthews, and today we will be Fed bashing.
Yes, so as everyone probably knows now, the Fed left its dot plot unchanged, pointing to 3 cuts this year, but raised its inflation forecast and its growth forecast for this year. So the question is, has the Fed lost the plot?
Almost definitely, I think. Jonny, do you think the Fed has lost the plot on inflation after the last Fed meeting? We saw the Q&A and Powell's comments.
I wouldn't say they've completely lost the plot, but I do think they've gone a little bit soft on it. And I said this prior to the meeting. I said this in our prior podcast that I do think the Fed will stick with the 3 rate cuts for this year because that's what they said. But I'm not so sure it's the right policy move because I think inflation is the disinflation that we've seen so far is going to stall. Goods disinflation or goods deflation that we've seen is going to come to an end soon. Used car prices aren't going to keep falling. So goods price inflation, which was a drag on the headline, it's no longer going to be a drag. And we're seeing services inflation incredibly persistent. And now we've got energy costs that are creeping up higher as well. So I don't think the Fed is in the clear, but I will say this. I don't think the Fed is going to try and drive inflation all the way down to the 2% target if the economic cost of doing that is too great.
That's a fair comment. So you're telling us that the Fed target or might be openly 2%, but they might accept a higher rate between 2.5 and 3 and be comfortable. But just on my mind, the Fed have driven themselves right into a corner here. They have to have inflation no higher, probably even coming lower over the next few months for them to justify cutting rates. Because what are they going to do? Say if inflation picks up again, they're going to say we're still cutting rates because that's our forward guidance. What happens then?
Well, that's a very interesting point. Let me just bring up this chart. So this is
super core.
This is super core, but it's the same kind of thing we're seeing whether you take regular headline inflation or core inflation. If you look at the 3-month annualized rates of inflation or the 6-month annualized rate of inflation, they've both picked up dramatically because we had 2 very high month-on-month gains in the consumer price index in January and February.
So the comps are much harder to beat, in other words. That's what you're saying.
Well, it's just if you take a 3-month period, you've got 2 very big jumps in the price index in those 2 months. The 3-month annualized rate has jumped higher. And Powell was asked about this in the meeting, and I've got his response written down here. There's reason to think there could be seasonal effects there, which haven't changed the overall story. So he's now saying, I think this is just seasonal noise. And I think that's a very dangerous thing for him to say, particularly after the transitory fiasco.
Oh, absolutely. So if you are looking at the chart, the beginning of 23 to the middle of 2023, you've talked about this before, but Powell was mentioning supercore. Look at supercore rates coming down. We're happy. Funny enough, he doesn't say the same thing when it's going up.
Well, this is what does concern me, and I chose supercore because, as you probably know, we had OER, owners equivalent rent, that made a kind of unusual jump in January. But supercore inflation is core services inflation less housing. That effect from OER is not in this data. So I just think it's dangerous to just put it down to seasonal effects. I've never heard a previous Fed chair talk about seasonal effects as distorting the data.
So a question for you. Clearing price of treasuries is essentially whether they're going to let Powell get away with this particular policy that he wants to pursue, cutting rates. But why haven't the bond vigilantes hit him a bit harder? You know, I can see the 10 years trading around, the 420 level, somewhere around there. You'd expect with this sort of closing your eyes to inflation and saying we're going to cut rates, that's it, and hopefully inflation does what it does what we want it to do. It makes it fine. What are you seeing at?
Yeah, I think investors believe that the Fed is going to lower rates. So currently the overnight rate is about 5.3%. And they're saying to themselves, well, if the Fed's going to take rates all the way down, I better lock in a 10-year rate now while I still can at north of 4%. Without any regard for the implications for inflation and what may happen to rates beyond the short-term horizon if inflation picks up again. So I think investors are just saying, right, I've got to lock in a high rate now while I still can. They're also anchored, their expectations are anchored by that period after the financial crisis where Treasury yields were stuck down at, 2% and went right the way down, down and down and down. And it was hard to find anything with a half-decent yield.
Well, let's just play devils with you. I feel the same way you do, but let me play devils with you. Last year, we saw inflation coming down, employment market gaining constantly and strongly, and perfect scenario for the Fed. They could see employment gains still coming in, but inflation coming down. Added to the fact this year, we've got real rates of the 10-year just a fraction over 2%, which is restrictive to a certain extent. So why wouldn't the Fed cut rates and be happy to do so?
Well, first of all, I think I would ask the question, why is it necessary to cut rates? Why do you need to cut rates now? The economy is doing fine. Inflation is still elevated. Services inflation is still being driven by high rates of pay growth. And let's just now focus on the labour market data. So Powell, I believe, said that he was seeing some softening in labour market indicators. Don't forget, he's said for a long time, we're going to be data dependent now, not forecast dependent. We're going to be data dependent. Well, you look at the last 3 months of payroll gains, the average in the last 3 months was 265,000. The average payroll gain in the 3 months prior to that was 234,000.
Yeah, but you could also make the point, this is with unemployment below 4%. They're still creating this amount of jobs. It's quite tremendous economy.
Yes, there is still something of a labour shortage, actually. There are more available jobs than there are available workers. But there are some signs of softening in what I would call some forward-looking indicators, but they're not necessarily super reliable. Let me turn to the next chart.
NFIB.
Yeah. Now, this chart gets cited by a lot of analysts where they just look at the last 2 years, and this is the NFIB hiring plans advanced by 2 months. And there are points on this where you can see a spike in the NFIB hiring plans, and then 2 months later, job gain spike, and vice versa. There is some kind of loose correlation over the last couple of years. But if you look over a longer horizon, it's a terrible predictor of payroll gains. It really is. I mean, it's just throughout the period immediately after the financial crisis, it had very little relationship whatsoever to job gains.
Well, this is a chart that Powell could take, couldn't he? Because as you said, that the Fed should be data dependent, and it definitely is data dependent, as long as the data fits the narrative of cutting rates, and that would fit the narrative of cutting rates if you follow the NFIB hiring survey. Yeah,
but I would say that's a less reliable indicator. I think this next chart. Now, this is one chart that I do think has some sort of predictive power, where we're looking at the quits rate advanced by 6 months from the JOLT survey and the Atlanta Fed wage growth tracker. Now, the Atlanta Fed wage growth tracker is a much better measure of wage increases because it looks at people's earnings industry by industry and at the same level of job seniority. So it adjusts for a change in the mix of the workforce. So it's not affected by, for example, situations like after the pandemic, when the US fired 20 million people, most of them in the leisure and hospitality sector, most of them lower paid workers. And so then you see average hourly pay jumping because you got rid of all the...
This is what Powell could be talking about when he talks about he's seen some sort of easing in the labour market. Would you say that? Or?
Well, I would say this... It's a forward-looking indicator, yes. And the Atlanta Fed wage growth tracker does kind of closely match the employment cost indicator, which is the Fed's preferred measure.
Yeah.
So you would expect both measures, just looking at this chart, to continue declining. And that really says that, okay, wage growth is slowing, and that should feed through to services inflation. But that's, you're making two assumptive steps here. You're saying, right, okay, we've got a 6-month lead from the JOLTS data showing that pay growth is going to come down, and when pay growth comes down, services inflation will come down. But I do just want to say the latest JOLTS data that we have is for January, and I've got a chart in this weekend's Super Macro, which will show that if you actually look at job demand, while corporate profits are rising, it is much stronger, and we're seeing corporate profits, had a fairly stagnant year last year, but now they're on the up and up, and there's no reason, if profits are rising, there's no reason for corporates to shed workers to boost the bottom line.
So just to be clear, if you want to take a look at these charts plus many others in the weekend note, you can subscribe to the note at www.super-macro.com. Very easy. You get a 30-day free trial, and after that, it's 50 quid a month. And just to make the point, anything Jonny says here, all we say in the note is purely opinion, is not investment advice.
That's quite correct. Thank you. Thank you, Elvis. There's one other very important chart that's in the note. I've updated that chart that I showed earlier in the week, which shows how the Fed has an incredible ability to talk down the rates market. In other words, to boost treasuries, to lower yields. I've updated the chart, and I've used the 2-year treasury this time. So whether it's the 2-year or the 10-year, since the Fed did the first hike of this cycle in March of 2022, those yields have gone up about 250, 260 basis points. And yet, throughout that period, at most Fed meetings, the yields declined a long way. Powell managed to talk yields down during his press conference.
That's an incredible feat that he's managed.
It is, and it's not only has he talked them down, he's managed to talk them down a long way. If you look at the declines on the days of the Fed meetings, they are between 2 and 3 times as big as those few occasions when yields rose on the day of a Fed meeting.
So is that him just being dovish, or the market's got ahead of itself before the meeting and they're just correcting?
Well, no, this is just on the day of the meeting from the close.
Yeah, I get that, but is the reason why the yields go lower? Is it just him, or is the market already priced in too much before the meeting?
You mean too much hiking before the meeting, and then? Well, either way, it doesn't really matter. What happens is the market has an expectation for what the Fed will do, what the Fed should do, but comes the Fed meeting, super dovish, more dovish than the market expects, or perhaps is justified, and he manages to get the yields right back down again.
I suppose you could argue that it's his labour market comments at the meeting when he said, yeah, look, if inflation doesn't come down but the labour market weakens, we could cut rates, and if the labour market stays strong, well, so that's fine. Last year it was strong and inflation still came down, so therefore it only matters if it's a dovish reading.
I agree, but I would say, I would say this: why do you need to cut rates? Financial conditions have already eased dramatically. Household wealth has gone through the roof. Since the pandemic, household wealth has gone up by I think something like $40 trillion, went up another $4.8 trillion in Q4. And you could say, well, what does that mean? It means households don't really need to save as much. If you're thinking about retiring, you can cash in your 401k now and you don't have to work. That will reduce labour supply. Yeah, exactly. And we already have a shortage of labour. Plus, from the corporate sector, it's lowered the cost of capital. Credit spreads are super tight.
Yes.
Treasury yields have declined. Corporates are not struggling with high rates, except in some cases, these zombie companies are really struggling. But that was always to be expected.
Well, you're painting a picture where the US is potentially going to get itself in an inflationary spiral. They've already got a strong economy and they're going to cut rates into a strong economy. So what's going to be, I wouldn't say the shock absorber, what's going to be the canary in the gold mine? What's the first thing that goes, the currency or the 10-year?
That's a great question. I do think that this stimulus that they've injected into the economy as a result of the dovish talk and as a result of all these financial conditions loosening as much as they have will give a lift to economic growth, even ahead of the first cut. Now, what is going to be, where are we going to see the first signs that perhaps they've made a policy mistake? I really thought that we'd see Treasury yields come under more pressure. When I say more pressure, Treasury yields to start rising, and I still believe that is the case. Where I have been slightly mistaken is I thought the dollar would take it on the chin, and we'd see gold, other precious metals rising. We've certainly seen Bitcoin and crypto going crazy. I would have thought we'd see a stronger response from precious metals.
They've had some response. It's been a little bit muted so far, but I suspect that they're in an ascending pattern.
Yeah,
in terms of price.
It's difficult with them because you've got to, but mind you, I suppose the same applies to crypto. You've got to overcome the fact that the overnight rate is 5.3%.
Yeah.
So you're giving up that to invest in something that relies on the greater fool theory. You're expecting someone else to come along and pay more than you did for whatever it is you bought. But there's no real fundamental valuation reason for it to continue going higher.
But the world seems to be picking up. Emerging market economies, China, etc., seem to be moving in the northerly direction in terms of their economies. So you could say that precious metals and maybe just industrial metals could get a boost from that alone.
Well, I think the big one is India. The PMIs are north of 60. And
yes, I saw that. Yeah.
And they do like buying gold. But it's quite surprising. So far, the buying of gold has been driven by central banks.
Yes, I noticed that.
Not the retail sector. So, it could get a tailwind. But it's not, I think the clearest expression, if you really are worried that this is a policy error by the Fed, I think the clearest expression is to be short the long end of the Treasury market.
Well, it comes around to my final question for you. Like anybody listening, they want to know what you're doing. What are you doing? What scale of it? What is a scale of it as well in terms of size, in terms of your maximum size being 10, minimum size being 1? What are you putting on and why?
Well, first of all, let me say I spent 12 years as a portfolio manager at one of the largest hedge funds.
We shouldn't say that, or we didn't say that. Sorry.
Well, yeah, and 12 years before that as a trader in an investment bank. My experience is that there's only really one or two good trades per year.
Okay.
And you've got to really wait for the opportunity, and then when it comes, you've got to really pile in pretty big size. So at the moment, I'm being quite cautious. I've had a reasonably sized long position in European banks, and that's done extremely well this year. And my short position in treasuries on a scale of 1 to 10 is now down to about a half. And
what, 5 or a half of 1?
A half of 1.
Oh, really? Okay.
Yeah. When I looked at how the Fed could could influence Treasury yields the way they did.
Yes.
I looked at the history.
It's quite
there.
frightening to be short.
Yeah, it is. And I protected myself with a lot of call options, which have taken me out of pretty much all the position. I sold another small amount out. Longer term, I do think Treasury yields are going higher, and I will look to increase the size of that trade.
So Treasuries, short, very small, will scale into it when the price action starts moving away. Okay. Next, what about equities?
Well, I think that's another reflection of dollar debasement in a way. If the Fed is just going to cut rates, regardless of how strong the economy is,
Buy it all.
yeah,
Buy everything.
you've got to buy everything that's not nailed to the
buy
floor.
everything dollar,
effectively.
you can do in dollars. That's it. Finished.
Yeah.
Get out the dollar.
Yeah, get out the dollar. Just buy everything that's not nailed to the floor. And it's interesting, actually, that we're seeing now with the industrial. We're seeing the early signs of an industrial recovery.
Yes.
We're seeing the manufacturing PMIs beginning to turn more positive now, and certainly in the US, we're seeing Asian export growth picking up, and that is being reflected in higher base metal prices, and some of these deep value sectors like the miners are doing quite well now, which is great for the FTSE. But, the FTSE's been a dog for years.
Oh, Christ, yes. I've been hearing that from
you and I-
numerous friends of
yeah.
mine who've owned FTSE and been complaining.
Well, I think we all have living
Yeah,
in
it's
the UK,
just- yes, yeah.
in our ISAs. So, but now I think it's doing quite well, and
FTSE's a mining index. It's not really UK PLC. If you want to own the UK, you'd own the 250, I assume, wouldn't you?
Yeah. I mean, the FTSE is miners, oil drillers, a couple of very good pharmaceutical companies, and banks, and the rest of it doesn't really count for that much. So
talking about banks, European banks has been a favourite of yours. Are you still long, and do you still say you want to stay long? Will you add to your position?
Well, I think the only thing that makes me a bit cautious now is the banks have had a fantastic run this year.
So is it time to take chips off the table?
I think it is. I do think it is.
Okay.
Only because I've had such a great start to this year.
Yes, I'm going to ask you, what is your performance this year so far? The portfolio.
Well, it's 13%, and that is in the
that's year to date. Year to
that's
date.
Year to date. That's
Yeah.
in the note. All my positions are listed there in the note. You can see, and you can track how they perform each week. And
Just one more plug. See below me where you got to hit www.super-macro.com. You can register for the note. You can see previous notes. See a picture of me and Johnny. That will make you feel good. Not. Okay, everybody, thank you for listening. You've got the details of where you can get hold of Johnny, and we'll post early when we're about to produce podcast 4. Thank you very much indeed.
Yep, thank you, everyone. I'm looking forward to the next podcast, and hopefully we'll give a countdown to it next time.
Yeah, definitely.